My name is Olivier Desbarres. I'm a London-based independent macro and currency strategist. I would argue that a number of factors have underpinned this bullishness in equity markets and relative calm in other asset classes, and some, if not all of these economic, financial and political factors seemingly still have a shelf life. If we look at global growth, it has been inching higher to about 3.5%, with the IMF forecasting growth to slowly rise next year. This, of course, masks significant divergences in individual countries' performances. For example, we know that UK growth is well below the G7 average, and India's GDP growth rate has dropped to a three-year low, 5.7%, from 9% 5 quarters ago. Moreover, these overall GDP numbers mask some concerning trends, including the rise in income and wealth inequality. But the overall picture is that the threat of a global recession, broadly defined as 2% or less growth, has clearly receded. And I would argue, importantly, that this has partly been due to a very accommodative monetary policy, the result of ultra-low policy rates, and the Fed, Bank of England, Bank of Japan, and European Central Bank introducing comprehensive QE programs. Large asset purchase programs have swollen the balance sheets of banks and large corporates. This has enabled banks to lend, particularly to households, and enabled corporates to invest and, importantly, finance share buybacks, which has in turn supported equity markets. If we look at the ECB and the Eurozone, the picture there is one of GDP growth rising to around 2.5%. It would seem that the Eurozone is benefiting from the lagged impact of the ECB's ongoing quantitative easing program. Put differently, the rebounding growth, which we saw in the UK and the US after these two economies introduced QE in late 2008, is now materializing in the Eurozone 2 years after the ECB first introduced QE. Moreover, the European Central Bank's purchases of Eurozone sovereigns bonds and corporate bonds have arguably reduced the risk of default for the Eurozone's poor economies and contributed to low interest rates and debt repayments costs for Eurozone governments. Going forward, I expect developed central banks to hike their policy rates only very slowly, with global interest rates remaining low by historical standards and monetary policy remaining stimulative. Looking ahead, whilst the ECB may very well announce a reduction in monthly purchases from 60 billion euros at its 26th of October policy meeting, the expectations in the market are that the ECB will extend QE into 2008 and potentially beyond in order to support economic activity and further push up inflation. Turning to the Fed, the message that I'm getting there is that the central bank has learnt the lessons from Bernanke's 2013 so-called taper tantrum. The Fed has given markets a lot of time to digest the idea that it would eventually start shrinking its balance sheet. And the announced reduction is slow and gradual, in my opinion. A 20% reduction over 2 years, according to my estimates. The Fed clearly wants to wean banks and corporates off the liquidity that they have enjoyed in recent years, but the medicine is being withdrawn only slowly. Turning to the Bank of England, it's very clear that a 25 basis point hike is potentially on the cards at its next policy meeting on the 2nd of November. But this, in effect, would only reverse the post-referendum emergency cut, with the policy rate at a still historically very low 50 basis point. The Bank of England, moreover, may well take the sting out of a rate hike by emphasizing that future hikes will be very slow and gradual, effectively mimicking what the Fed did in 2015 and 2016, when it only delivered one hike a year. Other major central banks, including the Bank of Japan, the Reserve Bank of Australia, and the Reserve Bank of New Zealand, seem to be in a holding pattern for now, while the Bank of Canada, which hiked rates both in July and September, seems to be cooling market expectations of another hike before year-end,